Howdy, hot shots. Dividend Daddy here, your favorite not a financial advisor with not financial advice. A little bit of a red day in the market today. Could that be the best time to invest in some of these high yield covered call option ETFs? We've got ULTY down around 617. I look through my ETFs and all I see is a sea of red, with the exception of GDXY, I think was up a little bit today. I'd have to look, but ULTY is down below 620. I've been I did buy some shares up around 640 because you just don't know when it's going to keep going up. You don't know when it's going to keep going down, but red days is the day that if you want to accumulate shares, you want to accumulate them on red days, because the lower amount that you pay per share increases your yield, right? If you pay $6.40 and you get 10 cents, that's going to be a lower percentage than when you pay $6.20 and you get 10 cents per share in distribution. So today, I had kind of a waterfall schedule of purchases just lined up in my account. I bought 100 shares yesterday at around $6.25. And I had a 25 share purchase price at $6.22, and then 100 shares at $6.20 and 100 shares at $6.18. All of those purchases got triggered today. It's down to about $6.17 last time I looked. So it's actually a little bit below the range that it's been in, between $6.20 and $6.40. But to be fair, my VU and my VGT and my SCHD and my VUG, they're all down today. So I am not bashing on ULTY with the price being down. What I am saying is that if you're still trying to accumulate shares, which I am still trying to do, then a day like today is a good day to do that. Now, obviously, if you're going to make the bet, you got to vet, okay? So you have to decide for yourself. But it's a very hard psychological thing that you have to get over when trading or investing. Now, you could do automatic, I'm just going to buy every month no matter what the price is. That's a little bit easier psychologically than to just specifically buy on red days. I try to buy on red days for the most part, but sometimes I do buy on green days just because I feel like if it keeps going up, I don't want to miss out. But if you're accumulating shares, red days are a good time to do that. But psychologically, it's hard because you're like, oh, it's going down, and so I don't want to buy more of it. It's just going to keep going down. But red days, buying right is where you make your money. So if you want some of these high yield funds, red days are definitely the days that you want to add to your holdings. And I did that. I added some, I add something almost every single day. But today I bought a little bit more than usual because it was a red day. And so, like I said, I have these triggers I have limit orders in that I put in good till canceled. And so I go, okay, well, I noticed that this day ULTY dipped down to 616. Maybe a week ago, it dipped down to 616. But it was a very quick dip, and then it went right back up. So I go, well, if it gets down that low again, I want to buy some shares. And so that's when I set in that little waterfall set of limit orders, where on its way down, I would just pick up a few more shares as it goes down. And so I got some shares at 625 yesterday. I got some shares at 622 today. I got some shares at 620 today, and I got some shares at 618 today. And my holdings on ULTY are getting up there to where I could actually see some significant income from it. Now, obviously, if the NAV erodes and offsets that income, that's not going to be ideal. But if it does hold tight in, above $6 range, and I can continue to get that income for a significant amount of time, it's going to pay off beautifully. So we'll just have to wait and see, because we don't know the future. But what I will say is that ULTY has revamped their fund. They have actual underlyings, and so on red days in the market, it's going to go down. And they have some put options in place to protect their downside, but that's not going to protect it 100%. And then they have the income that they're generating from their covered calls, which is going to cushion the blow on any kind of market downturn as well. So do I know 100% that this is going to be a profitable venture? No, because then I would just 100% go put all of my money in it tomorrow. but I'm not doing that. It's a fairly small position that I have compared to some of my overall holdings. But I will say that when it comes to ETFs, it's getting up there to where it's probably one of my largest ETF holdings, at least in the top 5. And I definitely have very few stock holdings that are larger than ULTY, okay, because I want that huge distribution. I want to be able to retire off the income. I don't have to worry about it as much, generating as much income as some people might need to retire, because I just need to supplement my retirement. I do have a retirement plan in place already, but I would like it to supplement my income to the point where I actually don't have to take a pay cut when I retire. And I have about 7 years to accomplish that. So I need to get my holdings up. Now, if I were to try to do that in SCHD by itself at a 4% yield, let's say I want to make about $150,000 a year off of dividends, then I would have to have about $6 million in ULTY, right? $6 million, $4,000 per $40,000 per million, 240,000. Okay, about $4 million probably in SCHD. And in ULTY, if it can hold up that 80% distribution, even if there's a little bit of NAV erosion, let's say I can net 50%. If I could net 50% per year and I need 150 grand, I only need $300,000 in ULTY. So that's a huge difference with those large distributions. And that's what you need to look at when you're deciding what type of investment to be in. If you're going to be needing income and not just growth, then you're going to get a lot more income from somebody writing covered calls than you are just from the dividends on underlying companies. And so a 4% dividend versus an 80% distribution rate, that's 20 times as much money as you're going to need in order to get the same type of distribution. Now, there's other things that factor in, like the growth rate of SCHD versus the growth or decay. And it's not even really decay, just a reduction in value of a fund like ULTY. And so that has to be compensated for. I am hoping that the distributions from the covered call income outweigh any kind of reduction in value that ULTY has. Even if it goes down 30%, but I keep an 80% distribution, if I can net 50% per year, that's a huge return. I mean, there's not very many investments out there that you can be as hands-off as you can with an ETF and make a 50% return. Even 20% would still be a good income on your money, right? So none of us know the future. We just have to pay our money and take our chances. But I'm really hoping that this distribution holds up for a while. And if it does, because I drip my divvies, if I can keep building the number of shares that I have, it really won't take, at that type of a distribution rate, it really won't take that long until I have enough money in there in order to supplement that retirement. And I really don't think, in the circles that I run in, I don't think there's anybody that couldn't live off of $150,000 a year. And if you really could net 50% per year out of a fund like that, that's only 300 grand. I mean, people would be a lot closer to retirement than they think they are if they only need $300,000 to retire. Because a lot of people think that you have to be a multimillionaire. And I would say with traditional type investments, that's 100% true, because yields aren't, with the low rates, the way they've been artificially kept low for so long, you're lucky if you can get 4 or 5%. So if you don't want inflation to eat away at your holdings to the point where your 4 or 5% won't let you live, you would have to have millions of dollars so you could keep reinvesting part of that money. If you're getting 4% and you have $5 million, you've got $2 million in there. If you spend that, $5 million 4% return of $200,000 a year, if you spend that whole thing, your $5 million eventually is only going to be worth $2.5 million, and now your $200,000 is worth $100,000, and then you can't live on it. So you have to be making enough money in retirement to reinvest part of it so that your principal can continue to grow, so that your income can go up to counteract inflation. So you need something with some sort of a high yield, or you need a bunch of money to start with. And I don't have as much money as I would like to start with. So I need something with higher returns so I can either get to that principal level. Now, if I had $5 million, would I put it in ULTY? No, because if I had $5 million, I could put it in something more conservative and get the income that I need. But I don't have $5 million. And so I would like to use a smaller amount of money to make a larger return. And that's why I'm looking at these covered call funds. And I have several of them because I like to spread the risk out. But my largest holding of them is in ULTY right now.